This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, how did you get on with that example? Did you find it okay? Bit of a challenge? You probably found it a little bit of a challenge, but that's because it's the first question you possibly ever done on interest rate swaps. The more of these questions you do, the easier you will find them. They become very repetitive, very cyclical, and much easier to go through there and understand. So what was your answer? Did it look something like this? Did A go through there and take out a fixed rate loan and end up with a variable rate at cheaper than what it could get by itself on the market? And did B take out a variable rate loan and end up with a fixed rate loan cheaper than what it could get on the market? Yes. Did you have the LIBOR payments from A to B? And then did you have, was it that balancing figure that B made to company A at 9.25? Yes? No? If you did, get on to the next section. You don't need to listen to me. If you didn't, let's go through and chat through it, shall we? Make sure that you're happy with it. So what have we got? In terms of the question, similar scenario. You've got two companies, company A and is it their company B? Again, you're given that sentence at the bottom that does tend to help you, but you're not always going to be given that sentence. But it says the company A's income fluctuates with interest rates. If that's the case, then company A should take out floating. If B's does not, then company B should take out fixed. Hence, that's why the company B ends up with fixed and company A ends up with floating. Okay, that's what they want, isn't it? Remember, the one way of looking at it is saying, well, look, if one company wants floating, it should borrow fixed. And if the other wants fixed, it should borrow floating. That is one of the ways that my tutor used to teach me, but you know, if it didn't tell me that bit of information at the bottom, I was just, what's going on? Okay, so the best way to look at it, I think, is look at the two companies, company A and company B, and see which one has the advantage, and look at the one whereby we have the advantage in the market. Okay, so here you can see company A, company B. Company A has the advantage in the fixed market. It also has the advantage in the floating market because it can borrow cheaper in both. So company A has, if you like, an absolute advantage, doesn't it? Okay. However, company A should borrow in the market where it has the biggest savings. So if that's the case, company A should borrow fixed, which fits in well because if we borrow fixed, it will end up floating. And therefore, if company A has borrowed fixed, in order for it to work, company B should borrow there, is it at LIBOR? Okay, so what we've got there is we need to work out, is it the interest savings? So we look at, is it with the swap versus without the swap? Okay, so with the swap, A was 10, B 11.5. Sorry, LIBOR plus 1.5, isn't it? Okay, without it, A would borrow floating, and A's floating was LIBOR plus 1. And B's fixed is there at, is it 11? So is that then with the swap, LIBOR plus 11.5. Without the swap, it's LIBOR plus 12. Okay, so with the swap, it is cheaper. The saving is 0.5, which is therefore 0.25 each, isn't it? Okay, divide by 2. Just be careful, it might not necessarily be a 50-50 saving. okay, you would need to go with what you are told within the question. If you're not told anything, split it equally, okay? So if that's the case, we then need to work out, is it the outcome? So what we've got there from the outcome, the outcome should be that A wanted, was it variable? And in the variable market, I think it could get, was it LIBOR +1? Let's double check. Yeah, company A, LIBOR +1. And then is it there, company B wanted fixed? And its fixed was there at 11. Don't forget, though, you've got the savings. It will make a saving by entering into the swap of 0.25 and 0.25, which means there that is LIBOR plus 0.75%, and is it there 10.75%? Okay, that should then be the outcome of the swap, and it is. If you go through there and pick it out, A wanted variable, so it started off with fixed. If it borrowed fixed, it got 10%. We need to get LIBOR plus 0.75 because that is the outcome of the swap. So in order to do that, we have to have there a LIBOR payment variable from A to B. And what then happens there is that the LIBOR payments then cancel. So B is making a payment of 1.5. It then needs to pay enough to get to 10.75. So 10.75 less 1.5, is it there 9.25? Okay, excellent. Okay, so B has now got fixed at 10.75, and A, is it there LIBOR plus 0.75? When you net it off 10, payment 9.25, receipt is a net 0.75 payment, isn't it? There you go. Okay, so if you can follow those steps, now looking at what the interest savings are, looking at what the outcome is, and then going through and showing how it works, you shouldn't fall on too many hard times. Again, there's two ways to look at it. I think the best way is to look at the companies that have the advantage and work out the company that has the advantage in which market and which market it has the best advantage in, and it should therefore borrow at that rate. Okay. The other alternative is to say, well, if one company wants fixed, it should borrow variable, and if the other wants variable, it should then borrow fixed. However, that may not work in all types of question. Okay, so have a go, work it through, keep practicing those questions. You'll get some wrong, who cares? The more you get wrong, the more you will learn from them, and then the more you will get right into the future. Yeah, follow the steps for swaps, and it will be an area whereby you are looking for that question come the final exam.